it's today again. Welcome back to Joseph's Reserves. I'm Joseph and I store 20% of my income in the form of rare coins and precious metals. Every Saturday, I sit down and review the weekly close of the major metals. We're going to look at gold, silver, platinum, palladium, copper, and see how this week unfolded and what it might mean for stackers and investors going forward. And we are going to do that today, but this wasn't an ordinary week. This week, we saw a downward trend and sell-offs in every single metal. And that doesn't usually happen unless there was an event to trigger it. And let me tell you, there was an event. But to really understand it, we actually have to understand the Federal Reserve. Congratulations to Silver Serpents for getting to the comment section in my last video first. Again, if you haven't checked out Silver Serpents, he has his own YouTube channel and he's about to get to his 500 subscriber giveaway. So definitely go check it out. So gold closed this week at $4,330 an ounce, which is down 4.6% this week. Silver closed at $67.72 per ounce, which is down 10.19%. Platinum finished this week at $1,785 an ounce, which is down 7.32% this week. Palladium closed at $1,247 an ounce, which is down 9.57% this week. And even copper finished lower, at closing at $6.31 per pound, and that's down 1.74%. Now, whenever you see gold down nearly 5% and silver down more than 10%, platinum and palladium are getting hit even harder. You start to ask yourself, what happened? Did inflation just disappear? Did government debt suddenly become a non-issue? Did geopolitical tensions suddenly vanish? Of course not. So why did investors dump metals this week? The answer that we need to talk about is something much bigger than gold and silver. We need to talk about the Federal Reserve. Because whether you like it or not, the Federal Reserve has enormous influence over the value of the US dollar, interest rates, bond yields, and ultimately the price of precious metals. This week, a major economic report changed how investors are thinking about the next move from the Federal Reserve, and that shift sent shockwaves through the entire metals market. So today, we already acknowledged the weekly closes, but we're going to be doing a deep dive in how the Federal Reserve actually works, how it influences the dollar, why employment data even matters, and why all of that translated into one of the worst weeks we've seen in precious metals in quite some time. So let's get into it. If you simply looked at the price action, you would assume that something catastrophic had happened directly to the precious metals, but that's not really what happened. The reality is that the market suddenly changed its expectations about future Federal Reserve policy. And when expectations change, the markets move, sometimes violently. Investors aren't just trading what happened today, they're trading what they think will happen tomorrow. This week, the market received economic data that suggests that the U.S. economy may be still running hotter than many expected. And that immediately changed the conversation about interest rates. Before we talk about why that matters, let's first understand what the Federal Reserve actually does. The Federal Reserve is a central bank of the United States. It was created in 1913 after a series of banking panics convinced lawmakers that the country needed a more stable financial system. Its primary response include, quote, maintaining stable prices, promoting maximum employment, supporting financial stability, and managing monetary policy. Notice something important. Even what they claim to do is not making stocks go up, making gold prices rise, or protecting your purchasing power. It focuses on the so-called broader economy. The challenge is that the goals often conflict with one another. A strong economy can create inflation, and fighting inflation can weaken the economy. So the Fed is constantly trying to maintain this balance. The Federal Reserve's most powerful tool is interest rates. Think of interest rates as the cost to borrow money. When interest rates are low, mortgages become cheaper, car loans are cheaper, business loans are cheaper, consumers spend more, businesses invest more, and economic activity accelerates. This is generally positive for growth, but there's a catch. More spending can eventually create inflation. Now let's look at the opposite side. When the Federal Reserve raises the rates, borrowing becomes more expensive, consumers become more cautious, and businesses delay projects. The spending slows and economic growth cools. Inflation pressure begins to ease. This is why every financial market on earth pays attention to what the Federal Reserve is doing. Interest rates affect virtually everything. And before we continue, we even need to talk about the misunderstanding of inflation. Most people think inflation simply means that prices are going up, but more accurately, inflation means that there is a decline of purchasing power. If your dollar buys less than it did a year ago, inflation has occurred. You see, inflation is everywhere: groceries, houses, healthcare, insurance, energy. The individual price increase is the symptom, but the loss of purchasing power is the disease. For precious metals investors, inflation matters because gold and silver have historically been viewed as stores of value. Many stackers own metals specifically because they want protection against this long term currency debasement, which makes this week's decline seem confusing. If inflation remains a concern, why did metals fall? The answer lies in the interest rates. And another thing that people are talking about mostly around what happened this week is about employment numbers. And many people hear employment numbers and immediately tune out. But employment data is one of the most important reports released each month. Why? Because jobs influence wages, wages influence spending, and spending influences inflation. Imagine employers competing for workers. To attract employees, they raise wages. Workers earn more money, consumers spend more money, and businesses raise their prices. Inflation increases. This is why a strong labor market can create inflationary pressure. The stronger the employment market becomes, the more concern the Federal Reserve may have about incoming inflation. So now we finally get to what happened this week. The latest employment data came out stronger than many analysts expected. The economy added more jobs than forecasted. The labor market appeared healthier than expected. At first glance, that sounds positive, and for workers, it generally is. But markets immediately begin asking the different questions. If employment remains strong, could inflation remain elevated? And if inflation remains elevated, will the Federal Reserve keep interest rates higher for longer? That possibility changed everything. When investors think interest rates could remain elevated, they often move money towards bonds. A bond is essentially a loan. Treasury bonds are loans made to the U.S. government. Unlike gold or silver, bonds pay interest. This increases the competition. Imagine if you are managing millions of dollars. You could own gold, or you could own a bond that pays attractive yields. And as yields rise, bonds become increasingly more attractive. More money flows into bonds, and money flows out of the non-yielding assets like gold, silver, and other precious metals. That creates pressure across this metals complex. Also, higher yields tend to strengthen the dollar. Foreign investors seeking those higher yields often purchase dollar-denominated assets. To do that, they need dollars, and demand for dollars rises. The dollar strengthens, which creates another headwind for metals. Gold and silver are priced globally in dollars, and a stronger dollar makes them more expensive for international buyers. They would have to trade their currency for dollars and then buy the gold and silver. That means that the demand softens and the price declines. So now metals are facing two problems: higher bond yields and a stronger dollar. That combination is often difficult for precious metals. But within all of this, we have the precious metals complex acting as they normally do. Silver dropped over 10% this week, more than doubled gold's decline. Why? Because silver is unique. Silver is both a monetary metal and an industrial metal. Gold is primarily a monetary metal. Silver has these two personalities. Investors buy silver and industry buys silver. Solar panels, electronics, medical applications, industrial demand makes silver more volatile. During bull markets, silver often outperforms gold, and during corrections, silver often falls harder. This week is a perfect example. And that weakness wasn't limited to just gold and silver. Platinum fell more than 7%, and palladium dropped by nearly 10%. Even copper closed lower, and this tells us something very important. The move wasn't isolated. This was a broad reaction across all of the metals complex. When you see a weakness across precious metals and industrial metals simultaneously, this is often a sign that macroeconomic forces are driving the market. And this week, the macro story was the Federal Reserve. Now, does this change the long-term bull case? Well, this is the question stackers really should be asking. Not what happened today, not what happened this week, what changed fundamentally? Did the government debt disappear? No. Did central banks stop buying gold? No. Did geopolitical risk just disappear? No. Did concerns about long-term purchasing power vanish? No. The long-term reasons many investors own precious metals remain largely intact. So what changed this week was the market expectations regarding future Federal Reserve policy. That's an important distinction. Short-term price action and long-term fundamentals are not always the same thing. But whenever we see these major corrections, emotions run high. Some people panic, some people celebrate, some people freeze. Personally, I try to focus on the long term. My goal is not to predict every weekly move. My goal is accumulation. I focus on ounces. I focus on building positions. I focus on maintaining discipline. And that doesn't mean price doesn't matter. It absolutely does. But if your time horizon is measured in decades instead of days, these periods of volatility become much easier to navigate. This week was a reminder that precious metals do not move in isolation. Gold doesn't exist in a vacuum. Silver doesn't exist in a vacuum. They are connected to the dollar, connected to interest rates, connected to employment data, connected to bond yields, and yes, connected to Federal Reserve policy. A stronger than expected jobs report led investors to believe that inflation risk may remain elevated, and that increased the possibility of a tighter monetary policy. It might push yields even higher and actually strengthen the dollar. And that is what created pressure across the metals market. Understanding that chain reaction is one of the most valuable skills a precious metals investor can develop. Because once you understand why the market moves, you're less likely to be shaken by volatility. The price may change, the headlines may change, but the underlying mechanics remain the same. Let me know your thoughts down in the comments, and as always, if you like this video, hit the thumbs up button, go into the comment section to start or continue a conversation, share the video with someone you think may like it, and subscribe if you haven't already. To my long-term subscribers, thank you so much for your continual support. And if you haven't already, go ahead and check out josephsreserves.com for my merchandise, my zip-up bags, and my It's Today Again coffee. At the very least, sign up for my monthly newsletter. But most of all, thank you so much for watching. And just remember, every ounce adds up. So no matter how small, just keep stacking.